As of pre-market trading on Tuesday, August 4, 2026, at 5:05 a.m. Eastern Time, Tesla stock is trading at $324.08 per share, up $12.87, or approximately 4.14% from its previous closing price of $322.08 on August 3, 2026. While regular trading hours are currently closed, the pre-market action reflects notable early momentum following a session where trading volume topped 33 million shares. Most market observers see Tesla stock purely as a vehicle tied to electric vehicle delivery counts and quarterly profit margins. But if you look beneath the surface of the latest order flow across major platforms like Robinhood, SoFi Invest, and Fidelity Investments, a very different story is playing out. Institutional money is not positioning itself around vehicle manufacturing units alone anymore. They are pricing in a dramatic shift towards software monetization, energy storage scaling, and autonomous fleet network economics. While the public retail narrative focuses on EV price cuts and competition from foreign automakers, big capital flows on the Interactive Brokers platform tell us that Wall Street is quietly accumulating during volatility dips. To understand where Tesla stock is headed next, we have to look at the gap between expectations and reality. The common consensus on forums, financial blogs, and retail investing sites suggests that Tesla is losing its edge as traditional automakers roll out competing models and slice away market share. Critics point out that valuation multiples remain elevated compared to legacy auto manufacturers, arguing that the stock should trade closer to traditional automotive multiples rather than tech software multiples. That expectation creates a structural bias, leading many individual traders using a standard individual brokerage account or basic Robinhood stop trading features to dump shares during short-term pullbacks. The reality, however, is far more complex and fundamentally different. Tesla is no longer operating solely as a car company, and treating it as one creates a massive analytical disconnect. When you look at the recent earnings reactions and daily price swings over the past several weeks, the stock has repeatedly absorbed heavy selling pressure near the $300 support level before rebounding sharply. During late July trading, after a volatile reaction to earnings guidance, the stock dropped toward $297.38 per share. Yet institutional traders on the Interactive Brokers trading desk used that drop to build heavy long positions, driving the price back above $320 within days. This aggressive buy-the-dip behavior highlights a critical market dynamic. Modern self-investing tools, automated options strategies, and products like Schwab Intelligent Portfolios or SoFi Active Investing are constantly rebalancing portfolio weights. When large capital pools reallocate, they compare Tesla stock against mega-cap tech giants like Apple stock and Nvidia stock. Investors evaluating an intelligent portfolio or examining wealth allocations across Fidelity IRAs and SoFi stocks recognize that Tesla sits at the crossroads of hardware manufacturing, custom silicon design, and large-scale energy infrastructure. If you are managing your own portfolio, take a moment right now and comment below with how many shares of Tesla stock you currently hold in your account, or tell me if you are waiting for a deeper pullback before buying more. Seeing how the community is positioned across different brokerage accounts gives everyone a real-time pulse on retail sentiment. To evaluate why daily volatility has been so intense, we need to trace the recent price action and institutional volume. Over the last month, Tesla stock has traded in a wide range between $297 and $420. Following an intense rally earlier in the summer that pushed shares near $420, profit-taking emerged alongside macro market anxiety regarding interest rate expectations and consumer spending figures. The selling hit a crescendo during mid-July, causing sharp daily swings where volume spiked above 115 million shares in a single session. When volume swells to those levels on platforms ranging from the Robinhood app and SoFi trading platform to full-service Fidelity wealth management setups, it indicates institutional portfolio turnover. Big funds were rebalancing out of high-beta tech assets into fixed income or Fidelity ETFs, while retail buyers using Robinhood fractional shares were stepping in to absorb liquidity. The recent surge back toward $324 shows that buyers are regaining control, supported by rising daily trading volumes and positive sentiment across tech sectors driven by ongoing compute expansion. Macroeconomic pressures continue to play a major role in short-term fluctuations. High borrowing costs impact auto loan approval rates and monthly payment affordability for retail buyers. When rates remain sticky, car buyers pause big-ticket purchases. However, Tesla has countered these headwinds through aggressive financing offers, flexible leasing terms, and targeted price adjustments. Furthermore, institutional investors using Interactive Brokers' fees advantages to execute high-frequency strategies are paying close attention to energy storage deployments, which have grown at triple-digit percentage rates year over year, providing high-margin revenue streams that hedge against vehicle margin compression. To ground this entire picture, let us examine the core business model that powers these financial statements. Tesla designs, manufactures, and distributes electric vehicles, solar energy generation equipment, and utility-scale energy storage systems like the Megapack. It also operates a massive proprietary charging network that has effectively become the standard charging infrastructure across North America, generating steady, recurring service income from non-Tesla electric vehicles. On the vehicle side, automated production techniques, gigafactory efficiencies, and vertical integration allow the company to maintain cost advantages over legacy competitors who struggle with supply chain fragmentation and dealer network markups. Past performance metrics demonstrate a track record of rapid expansion followed by consolidation phases. Years ago, critics questioned whether the company could reach mass production or generate positive free cash flow. Tesla proved those doubters wrong by scaling production from tens of thousands of units to millions of units annually, building cash reserves that allow it to self-fund massive capital expenditure projects without taking on unsustainable debt load. This strong balance sheet gives the executive team room to invest heavily in artificial intelligence training clusters, full self-driving software iterations, and humanoid robotics development. When investors log on to their Fidelity mobile app or open a Robinhood cash management dashboard, they often compare Tesla stock to tech market leaders. While Apple stock dominates consumer electronics ecosystems with steady cash flow, and Nvidia stock supplies the underlying compute chips for global artificial intelligence infrastructure, Tesla combines physical hardware manufacturing with proprietary software deployment at scale. That unique combination is why online investment platforms, Fidelity mutual funds, and SoFi robo-advisor algorithms maintain allocation exposure to the stock despite its higher beta and wider price swings. Looking ahead to future catalysts, the expectation versus reality framework becomes crucial. The standard market expectation is that vehicle growth will slow down to single digits while regulatory credit revenue gradually fades. If that reality unfolds, the stock could retest lower technical support zones around $280. However, the contrarian reality, and the scenario institutional investors are betting on, is Tesla successfully transitions from an automotive manufacturer into autonomous mobility and energy software provider. Key upcoming catalysts include regulatory approvals for unsupervised full self-driving software, fleet expansion announcements, and cost reductions for next-generation vehicle architectures. If full self-driving achieves regulatory clearance for commercial deployment, it transforms every compatible vehicle on the road into a potential asset capable of generating high-margin software subscriptions and ride-hailing revenues. Furthermore, expansion in energy storage deployments provides a massive growth runway that operates completely independent of automobile market trends. Risks remain present and should never be overlooked when managing your individual brokerage investments. Regulatory scrutiny around automated driving systems, trade tensions impacting international factory operations, and intense competition in overseas markets represent ongoing hurdles. If execution stumbles or product launch timelines get delayed, short-term selling pressure could easily pull the stock back down toward its 52-week support levels. Smart investors utilizing online investing strategies, investment help resources, and self-investing disciplines evaluate these risks carefully rather than chasing momentum blindly. Whether you use Fidelity Brokerage, an interactive broker's account, Robinhood Investments, or SoFi ETFs for your long-term wealth strategy, maintaining a balanced perspective